Most people know you can get a reverse mortgage on the home you already live in. Almost nobody knows you can use one to buy your next home instead. If you or your spouse are 62 or older and you're thinking about downsizing, moving closer to family, or getting into a home that fits retirement better, you've probably assumed you have two choices: pay cash for the new place or take out a regular mortgage and add a payment back into your life. There's a third option built specifically for this, and it's called a HECM for purchase. In this video, I'm going to show you how the numbers actually work, walk you through the process step by step, and cover exactly what happens to the home down the road, including a few things that get left out of most explanations. Here's the problem most people run into first. They've got cash from selling their last home or sitting in savings, and they think their only options are writing a full check for the new place or finance a thing with a monthly payment. Here's how it actually works. You make a required cash contribution at closing, and the HECM covers the rest of the purchase price. I want to be precise about that cash piece because it's not exactly the same as down payment on a regular mortgage. It has to cover the gap between what the loan provides and the home's purchase price plus closing costs. And the money has to come from a source that meets HUD's requirements, things like savings, retirement funds, or proceeds from selling your current home. What it can't be is borrowed money. How much the loan covers depends on your age or the age of the youngest borrower or eligible spouse in the loan, along with the home's value and the interest rate at the time. Generally, the older you are, the more the loan can cover, all else being equal. Let me give you an example, and I want to be clear that this is for illustration purposes only. Say you're 75 and buying a $500,000 home. Depending on the expected interest rate and the lender's pricing at the time, the HECM might provide somewhere around $203,000 towards the purchase. That would put your required cash contribution somewhere around $309,000 to $310,000 once closing costs are included. Your actual number could be higher or lower than this, so what matters is getting a real illustration to run for your age, your price range, and current rates before you make an offer on a home. Now, the process itself sounds complicated the first time you hear it, but it's a clear sequence. First, you get pre-qualified. Your loan officer looks at your age, the home price range you're considering, and gives you real numbers before you start house hunting. Second, you complete independent counseling through a HUD-approved counseling agency. This is required by law, and the counselor can't be affiliated with or paid by whoever is originating your loan. It exists purely to make sure you understand the loan before you're locked into anything. And third, the lender completes a financial assessment. This doesn't mean you're making a monthly mortgage payment, but it does mean that the lender checks whether you can reasonably keep up with property taxes, insurance, and any HOA dues over time. In some cases, part of your available funds get set aside specifically for taxes and insurance just to make sure those stay covered. Fourth, the fun part, you go hunting. The home has to meet FHA property standards. If you're looking at a condo, it generally has to be FHA approved, and co-ops aren't eligible for this program. I'd also recommend working with a real estate agent who has specific experience with HECM for purchase transactions, because not every agent has handled one. Fifth, once your offer is accepted, the lender orders an appraisal and finalizes your loan terms. Sixth, you close. You bring your cash contribution, sign the paperwork, and the loan funds the rest of the table. HUD requires you to move into the home within 60 days of closing since it has to be your primary residence. If this is the first time you've heard how this actually works, subscribe. I'm breaking down one piece of the reverse mortgage process in every video, so you're not stuck guessing at this on your own. Last thing, and this is the part people worry about most: who actually owns the home, what keeps the loan in good standing, and what happens later. So you are on title, exactly like any other purchase. A HECM is a lien against the home, not a transfer of ownership. What you're not required to make is a monthly principal and interest payment. What you are still required to do is pay property taxes, homeowners insurance, any HOA dues, and keep up with basic home maintenance. Those are the things that keep the loan in good standing. If any of those get missed, or you move out permanently, sell the home, or pass away, the loan becomes due. You can also make voluntary payments towards the balance at any time you want. Just talk to your servicer first so it gets applied the way you intend. Here's the non-recourse protection, and I want to walk through both directions this can go. If the home is worth more than the loan balance when it's time to repay, any equity left over goes to you or your heirs. If the loan balance ends up higher than the home's value, your heirs are never personally responsible for that shortfall. Say the balance is $400,000 and the home appraises at $350,000. Your heirs could keep the home by paying 95% of that appraised value, so around $332,500 instead of the full $400,000 balance. If they'd rather not keep the home at all, they can sell it or work with the servicer to transfer the property, and they still won't owe anything beyond what the home is worth. And since I'm an independent mortgage broker rather than tied to one lender, I'm shopping your specific numbers across multiple wholesale lenders instead of quoting whatever one company happens to offer that week. So who's this actually a good fit for? It tends to make less sense if your main priority is maximizing what you leave behind for your heirs, or if you think you might move again in just a few years. And I want to be straight with you on the trade-off, because this isn't free money. Interest and mortgage insurance accrue on the balance over time, which reduces the equity available later. The real question isn't just, can I avoid a monthly payment? It's whether keeping more cash available today is worth more to your plan than the equity you'd be giving up over time. That's a conversation worth having before you decide, not after. So that's a HECM for purchase. You bring required cash contribution based on your age, the home's price, current interest rates, and the loan covers the rest. The process runs through pre-qualification, independent counseling, financial assessment, house hunting, appraisal, and closing. You stay on title, and there's no required monthly principal and interest payments, but you still have to keep up with taxes, insurance, and maintenance. And because it's non-recourse, neither you nor your heirs are ever personally responsible for a shortfall beyond what the home is worth. If you're thinking about buying your next home this way, book a call with me at joshborba.com/meet. I'll put together a personalized illustration for you based on your age and price range and compare it against other purchase financing options, so you're working from real numbers instead of guesswork.